Imagine it's August 2022. You're a 34-year-old engineer named Wei, standing outside a construction site in Zhengzhou, central China. The sun is setting behind a haze of pollution, and you're staring at a concrete skeleton 17 floors up, 18 months frozen, rusted rebar poking from unfinished columns like bones from a wound. This was supposed to be your apartment. Unit 1204, 2 bedrooms, a view of the river. You paid the equivalent of $180,000 for it. That's everything your family had. Your parents' retirement savings from 30 years of work, your wife's inheritance from her grandmother, your own savings from 9 years of 60-hour weeks at an electronics manufacturer. You've been paying the mortgage for 2 years, 14,000 yuan a month. The bank doesn't care that the building isn't finished. The bank doesn't care that the developer, Evergrande, announced 6 months ago it couldn't complete the project. The contract says you pay, so you pay. There are 40,000 families in Zhengzhou alone in the same situation. Across China, that number is in the millions. You stand there in the heat, watching the empty cranes frozen against the sky, and you realize something that will take the rest of the world another 2 years to understand. This isn't a real estate correction. This isn't a policy adjustment. This is the end of an economic model, and you're standing inside the wreckage. The Western financial press has spent 3 years asking, is China collapsing? The question reveals a misunderstanding. Collapse implies a sudden break, a system that was working and then stopped. A Lehman Brothers weekend, a moment you can point to. That's not what's happening. What's happening is something more structural, more gradual, more irreversible. China isn't collapsing. China is discovering the endpoint of a system that was always going to reach this point. The architecture was drawn decades ago. The mathematics were set in motion long before Evergrande missed its first bond payment. The only question was timing. This isn't theory. It's documented history. And once you understand the mechanism, you'll see that China's property crisis isn't about property at all. It's about the fundamental design of post-reform China, the decision to build an entire economic model on a single self-reinforcing loop, a loop that required constant expansion, a loop that could never stop, until it did. The mainstream narrative goes like this. China experienced a property bubble. Developers got greedy. They borrowed too much, built too many apartments. When Beijing tried to rein them in with a 3 red lines policy in 2020, the bubble popped. Evergrande collapsed. Now there's a correction. This narrative treats China's property crisis as similar to America's 2008 subprime crisis, a speculative excess, a painful but necessary correction. The implication is that once bad debt clears, things stabilize. China resumes growing. The party manages the transition. This narrative is wrong. Not because the facts are wrong. Developers did borrow too much. There was speculation. There is a correction. But the framing is wrong. The framing suggests property was a sector of the Chinese economy, one part among many, important but contained. The reality is different. Property wasn't a sector of the Chinese economy. Property was the Chinese economy. And when you understand that, everything changes. Here's a number most analysts haven't fully processed. By 2021, real estate and related industries accounted for approximately 29% of China's GDP. Not 10%, not 15%, 29%. When you include construction materials, steel, cement, glass, appliances, furniture, decoration, real estate services, and the financial products wrapped around all of it, nearly a third of the world's second largest economy was tied to building and selling apartments. For comparison, at the peak of America's housing bubble in 2006, real estate and construction represented roughly 15% of GDP. The crash triggered the worst financial crisis since the Great Depression. Spain, before 2008, had construction at about 18%. The crash created 27% unemployment. Ireland, at the Celtic Tiger peak, reached roughly 25%. The correction wiped out the banking system. China reached 29%. And here's what makes China different. In America, housing was large, but the economy had other engines: technology, services, manufacturing. When housing crashed, those sectors continued functioning. In China, property drove almost everything else. Local government revenue depended on land sales. Household wealth was stored in apartments. Bank lending was secured by property. Steel production was driven by construction. The entire growth model was built on the assumption that property development would expand forever. This wasn't a bubble in the economy. This was the economy itself, structured as a bubble. To understand how China reached 29%, you must understand land finance. In Chinese, tu di kai zheng. In China, all urban land is owned by the state. Citizens don't buy land, they buy 70-year leases. So Beijing created a workaround. Local governments couldn't tax, but they could sell land leases. Here's how the cycle worked. A city government would designate an area for development. They'd relocate existing residents, often farmers, paying modest compensation. Then they'd auction land use rights to developers. Developers would pay local governments for land. That payment became local government revenue. In many cities, land sales eventually represented 30 to 50% of total income. Developers would borrow from banks to pay for land. They'd begin construction. And here's the crucial innovation. They'd sell apartments before they were built. Pre-sale, shu. Chinese homebuyers weren't buying finished apartments. They were buying promises, paying full price, often with mortgages, for units that wouldn't exist for years. Developers would take pre-sale money to fund construction. But more importantly, they'd use it to buy more land, more projects, more pre-sales. The cycle was self-reinforcing. As long as prices rose, everyone benefited. Local governments got revenue without raising taxes. Developers got cheap financing from future buyers. Banks got interest income and property collateral. Home buyers got assets appreciating 10 to 20% annually. Beijing got GDP growth. Everyone was winning. No one had incentive to stop. But there was a structural problem. The entire system required property prices to keep rising. Forever. The constraint no one wanted to acknowledge. Land finance only functioned if demand perpetually exceeded supply. If prices stopped rising, the mechanism would seize. Developers needed rising prices to service debts and buy more land. Local governments needed rising values to maintain revenue. Banks needed rising collateral to keep balance sheets solvent. Homeowners needed rising prices to justify having 70% of wealth in property. But there's a mathematical problem with forever. China's population wasn't going to grow forever. By 2022, China's population began shrinking for the first time in 60 years. The one-child policy created a demographic cliff. Fewer young people, fewer household formations, fewer first-time buyers. Urbanization wasn't going to grow forever. By 2023, approximately 65% lived in urban areas. The Great Migration driving housing demand was approaching its limit, and supply was already staggering. Estimates suggest China has between 65 and 90 million vacant apartments, completed, purchased, and empty, held as investments by families who already own homes. Some analysts estimate enough vacant housing to shelter the entire population of France, perhaps twice. Demand was shrinking. Supply was oversaturated. The entire financial system was predicated on the opposite being true. This is where it breaks. Japan, 1989. The Nikkei reached 38,957, the highest it would ever go. The Imperial Palace grounds were estimated worth more than all California real estate combined. Japanese banks were the world's largest. Japanese corporations bought Rockefeller Center, Columbia Pictures. Serious people discussed whether Japan had discovered superior capitalism. Then it ended. Over 3 years, property prices fell 60%. The stock market lost 80%. Banks became functionally insolvent. But here's what most don't understand. There was no dramatic crash, no Lehman moment. Instead, slow grinding deflation. Authorities didn't let banks fail. They kept the system on life support, forbearance, extend and pretend. The result, the lost decades. 30 years of stagnation, GDP growth near zero, wages flat, young people unable to find stable employment. Japan never recovered. The Nikkei didn't reach 1989 levels until 2024, 35 years. This haunts Chinese policymakers, not because they fear a crash. They can prevent that. They control banks, currency, capital flows. They can forbid selling, inject liquidity, arrest short sellers. They fear the aftermath. They fear becoming Japan. And here's the uncomfortable truth. China's situation may be worse. Japan in 1989 was already wealthy, high per capita GDP, educated population, decades of industrial capability. It could afford stagnation because there was a high floor. China in 2024 is not wealthy. Per capita GDP is roughly $12,000. 1/5 of America's, 1/4 of Japan's at 1989 level. China is growing old before it grew rich. The demographic decline that took Japan 30 years will hit China in 15, without accumulated wealth to cushion the blow. This is the trap. Every failing system was serving someone while it functioned. Local officials benefited directly. Promotion depended on GDP growth. Those who presided over construction booms advanced faster. Land sales funded impressive infrastructure. Everyone had incentive to build. Developers benefited spectacularly. Evergrande, Country Garden, Sunac became some of the world's largest corporations. In 2017, Evergrande's chairman was briefly China's richest person, worth over $40 billion. Banks benefited as long as prices rose. Trillions in loans backed by appreciating collateral. Non-performing loans minimal. On paper, Chinese banks were among the most profitable anywhere. First-generation homebuyers benefited enormously. A family buying in Shenzhen in 2005 for 500,000 yuan might have seen it valued at 5 million by 2020. For a generation, property was the greatest wealth creation mechanism in history. The Communist Party benefited most. Rising values created prosperity feelings, stability, buy-in. Hundreds of millions had direct stakes in system continuation. Everyone who mattered was winning. until they weren't. Then the costs became visible. Families who paid for unfinished apartments. By some estimates, over 2 million families paid for apartments never completed. They took mortgages, signed contracts, waited. Construction stopped. Payments continued. In 2022, homebuyers organized mortgage boycotts. They announced publicly they'd stop paying for properties developers failed to complete. The movement spread across dozens of cities. In China, collective action against financial institutions is politically dangerous. That families took this risk indicates the desperation scale, the young who can never buy. By 2020, Shenzhen home prices exceeded 40 times average annual income. For young workers, ownership became mathematically impossible without massive family help. Migrant workers. The construction boom employed tens of millions. When it froze, they lost income. No safety net, no unemployment insurance. They simply went home to villages with no opportunity. And future generations. Debts don't disappear when booms end. They roll forward. Future generations will work to pay off debts incurred building apartments no one needed. Benefits concentrated among those who built the system. Costs dispersed across those who had no say. In August 2020, the government did something that triggered the visible collapse. They tried to fix it. The 3 red lines imposed strict limits on developer borrowing. 1. A 70% ceiling on liabilities to assets. 2. A 100% cap on net debt to equity. 3. A cash to short-term debt ratio of at least 1. Developers failing these thresholds couldn't take new borrowing. The intention was reasonable. Beijing recognized dangerous over-leveraging. They wanted to deflate gradually rather than let it pop violently, but they underestimated something fundamental. The entire business model depended on constant borrowing. Developers didn't build, then sell. They sold first, used cash to buy land, borrowed against land to fund construction. Everything ran on future cash flows. When borrowing was cut off, the system couldn't adjust. There was no alternative model. The leverage wasn't excess, it was the model. Evergrande was first. By September 2021, Evergrande announced it couldn't meet debt obligations. $300 billion in liabilities. One of history's largest defaults. Country Garden followed, Sunac, Kaisa, Shimao. One after another, China's largest developers entered distress. The contagion mechanism. When developers stopped buying land, local government revenue collapsed. Land sale income fell 23% in 2022. Some provinces exceeded 40%. When developers stopped paying suppliers, construction materials contracted. Steel demand fell. Cement plants idled. When developers stopped building, prepaid homebuyers saw apartments frozen. Boycotts began. When confidence collapsed, potential buyers stopped buying. New home sales fell 30%, then 40%. Each link pulled down the next. The 3 red lines didn't cause the crisis. It was already embedded in the mathematics. They just revealed it. Removed the ability to borrow more to cover what was already owed. This is how Ponzi-like structures end. Not through fundamental change. Through credit access change, Beijing now faces 3 options. None work. Option 1, let prices fall. Allow markets to clear. Let developers fail. Let values find real levels. The problem? 70% of household wealth is in property. A 30% decline wouldn't just hurt speculators. It would destroy life savings of hundreds of millions. In any political system, that's dangerous. In one deriving legitimacy from prosperity, it might be fatal. Banks hold trillions in property-backed loans. If prices fall significantly, banks become insolvent. A crisis at China's scale would dwarf 2008. Option 2, bail everyone out. Massive fiscal stimulus. State banks absorb bad loans. Complete unfinished apartments with government money. Reflate the bubble. This was China's 2008 playbook. 4 trillion yuan stimulus. It worked. Bought another decade. But the same trick doesn't work twice. Debt levels are much higher now. Local governments already struggle to pay civil servants. More stimulus requires either massive money printing, threatening the currency, or massive borrowing, threatening fiscal balance. And stimulus doesn't solve the underlying problem. More apartments exist than people need them. You can't reflate demand for products no one needs. Option 3, muddle through. Don't crash, don't bail out, just manage. Extend loan deadlines, pressure banks not to foreclose, keep stable enough to avoid panic. Hope time absorbs excess. This is the Japan playbook, forbearance. The problem? This produces stagnation, slow growth. Zombie companies, zombie banks, capital trapped in unproductive assets. For Japan, this meant 30 years of drift. For China, with lower income and worse demographics, the drift could be permanent. 3 options, none painless. That's the trap. There's a layer rarely discussed. We don't actually know how bad things are. China's statistics come from the National Bureau of Statistics, reporting to the State Council. No independent verification, no private data agencies with raw access, no investigative journalists examining books without legal consequences. This doesn't mean statistics are fabricated, but they're managed. In 2023, China stopped publishing youth unemployment after it exceeded 21%. The explanation? Methodology revision. GDP figures are suspiciously stable, quarter after quarter hitting targets with remarkable precision. Independent estimates from satellite data and electricity consumption show different pictures. In 2017, Liaoning province admitted GDP figures were inflated at least 20% for years. Other provinces followed. We know the direction. Property sales down, defaults up, local revenue falling. But we don't know magnitude. True bad debt scale unknown. True unfinished apartments unknown. True unemployment unknown. We're looking through fogged glass. When authoritarian systems face economic stress, the gap between reported and real conditions widens. Soviet statistics showed growth until collapse. This isn't accusation, it's structural observation. When institutions producing data have incentive to manage perceptions, data becomes unreliable exactly when reliability matters most. China's property crisis isn't contained to China. China consumes approximately 55% of global steel, half of copper, nearly 60% of iron ore. Majority goes into construction. When China builds less, global commodity chains contract. Australia's economy depends on iron ore exports to China, Brazil's mining sector, Chile's copper, Indonesia's nickel, African nations dependent on Chinese purchases, all exposed. Iron ore peaked at $200 or $20 per ton in 2021, now below $100. Copper declined from record highs. Countries that rode China's boom now experience the downdraft. German machine tools, Japanese construction equipment, South Korean appliances. Industries built capacity for Chinese demand that may never return. Global investors hold Chinese developer bonds. Western banks lent to companies with Chinese exposure. Pension funds, chasing yield, ended up with Evergrande paper. Most importantly, China was the engine of global demand growth for 30 years. When advanced economies slowed, Chinese growth picked up slack. If China enters prolonged stagnation, that engine disappears. India grows, but at a fraction of China's scale. Southeast Asia cannot absorb the same volume. The world ran on the assumption Chinese demand would expand indefinitely. That assumption is now in question. One factor has no parallel in Japan, Spain, or America. Communist Party legitimacy has been explicitly tied to economic delivery. After the Cultural Revolution, after Tiananmen, the social contract was clear. The party delivers prosperity. The population accepts political constraints. For 40 years it held. GDP growth averaging 10%. Hundreds of millions lifted from poverty. A middle class that didn't exist in 1980, numbering hundreds of millions. Property was central. Rising values made people feel wealthy, made them stakeholders in stability. When values fall, the bargain is tested. This is why Beijing can't let prices crash. It's not just economics, it's political legitimacy. But Beijing also can't reflate. Xi Jinping spent a decade consolidating power on the premise he's different, not about GDP at any cost, about national strength, technological independence, ideological discipline. Bailing out speculators contradicts his entire project. He's trapped between imperatives. Let prices fall. Risk anger from families who lost savings. Bail out. Undermine ideological authority. Muddle through, accept stagnation eroding party faith over decades. No good exit. And the demographic clock ticks. Every year, population shrinks. Every year, retiree to worker ratio worsens. Every year, structural housing demand declines. Time is not on Beijing's side. Why did anyone think this could work indefinitely? The mathematics were always clear. A system requiring perpetual appreciation will encounter limits. Population slows. Urbanization peaks. Debt compounds. Yet for decades, sophisticated people behaved as though music would never stop. Why? Incentives. Everyone was paid to believe it would continue. Developers earned billions. Officials got promoted. Banks collected interest. No one was paid to ask uncomfortable questions. The nature of bubbles. They continue until they can't. The longer they last, the more people conclude they're real. In 2007, American house prices couldn't fall nationally. In 2019, Chinese prices couldn't fall because government wouldn't allow it. Political reality. Admitting the problem required action. Action caused pain. Pain cost jobs and promotions. So problems were pushed forward. And this is how complex systems fail. They don't fail when small. They fail when too big to restructure. Success makes change impossible. Commitments during booms become constraints during busts. By the time China's property problem was obvious, it was too large to fix. That's not Chinese, that's human. What history tells us. When an economy builds 29% of GDP on property, then that sector contracts. Adjustment takes decades. Japan contracted for 30 years. Spain still hasn't recovered pre-crisis employment. Ireland was absorbed into a larger European structure that cushioned the blow. China has no such cushion, no larger entity to absorb debts, no external demand to substitute for construction. The adjustment will be long. Debts accumulated from 2008 to 2021 will take until 2040 or 2050 to work through. Growth will slow, perhaps to 2 or 3%, perhaps lower. The era of Chinese miracles is over. This doesn't mean chaos, doesn't mean state collapse. It means stagnation. A Japan-like plateau, a generation less prosperous than parents expected. The question isn't whether this is happening. The adjustment has begun. The question is what happens to a political system whose legitimacy was built on perpetual improvement when improvement stops. History has precedents. Soviet stagnation in the 1970s and 80s. Latin American lost decades. Slow erosion of faith in institutions that promised more than they could deliver. The pattern is already in motion. This is historical and educational analysis, not financial or investment advice. The dynamics involve complex systems with multiple possible outcomes. No one can predict specific timing or magnitudes. So we returned away, standing outside that Zhengzhou construction site in August heat, staring at 17 floors of concrete that will never be his apartment. He doesn't know about land finance or 3 red lines or Japan comparisons. He just knows he paid for something he'll never receive, that his parents' savings are gone, that mortgage payments continue, that the system promising prosperity delivered something else. Millions of families across China face the same realization. The growth model they were promised, work hard, buy property, wealth compounds forever, was temporary. It required conditions that couldn't last. And when those conditions ended, costs passed to people like him. This is how these stories end, not with crashes everyone sees coming, with slow recognition that rules changed, that the future won't be like the past, that promises made were promises that couldn't be kept. China is not collapsing. China is transitioning from a system built on perpetual expansion to something else. What that looks like, no one knows. Beijing doesn't know. Analysts don't know. Families waiting for apartments don't know. But one thing is clear. The property economy powering China for 30 years is not coming back. Land sales funding local governments won't return to previous levels. Construction jobs employing tens of millions won't be recreated. Household wealth in apartments won't appreciate like before. These aren't temporary conditions. They're structural shifts. The only question is how long full implications take to unfold. History suggests decades. The mathematics confirm it. The pattern is already in motion. This channel exists to study these autopsies before they repeat, to understand how systems fail, to see patterns before they become obvious. If this lens was useful, subscribe. Most people never see these mechanisms until consequences have already arrived. By then, it's too late to understand, only to experience.